What is a forward price to earnings ratio, and why is it so important for long-term investors to understand this term? In today's video, we are going to be talking about the difference between a current price to earnings ratio and a forward price to earnings ratio, and why it may have a big impact on the future expected returns in your portfolio. Okay, so let's talk about, before we get to the forward price to earnings ratio, what is a current price to earnings ratio? What that means is based on its current earnings. Let's use the S&P 500. You could use this for any individual company, but let's use the S&P 500. A current price to earnings ratio is based on its current earnings today. What is the price you're willing to pay for $1 in earnings in the S&P 500? Okay, great. Very simple. There are no expectations. Here's the current earnings. That's the price that I'm willing to pay for every dollar in earnings. What is a forward price to earnings ratio? Well, this typically looks forward the next 12 months and says, okay, these are the expectations for this investment. This is what we think its earnings are going to do. What are we willing to pay now for $1 in earnings? What are we willing to pay today for the future earnings of this company that we think it's going to happen? Now, keep in mind, as we've discussed in the past videos, there are no facts about the future. So this is a forward-looking guess. Okay, why is that important? And how does that impact the estimated rate of return that investors should think about? Well, let's go to this chart. We've looked at this before, but this has got two different scatter plots. Let's focus on the one on the left first. This is from top to bottom, the rate of return that you've gotten over the next 12 months based on the price that you've paid going from left to right. So your returns could go from -60 to +60. And you're buying the S&P 500 anywhere between 8 times earnings all the way to 26 times earnings. And if you look at all of these dots, what you can see is they're pretty random. And so what does that mean? It means you can buy the S&P 500 for an expensive price or for a not so expensive price. And the next 12 months, based on history, it's not a great guide. Sometimes it's up, sometimes it's down, which just goes to show us people are willing to pay more and less on any given year. But what happens is we move over to the chart on the right and we say, okay, based on the price you pay, what do the next 5 years look like for my returns? And now what happens, all those dots, they start to converge in a downward sloping line, which is a very clear story that says the less you pay for an investment up in the top left, the higher your rate of return will be for those future cash flows. And as we go over to the right, the more you pay for those same future cash flows, the lower your rate of return has been over the next 5 years. Okay, so looking at those two charts, why is it important, Kyle, that you said we should know about current versus forward price to earnings ratios? Well, let's look at the top of this chart. At the top of this chart, this is not the current price to earnings ratio. This is the forward price to earnings ratio. And so if you just looked at this 5-year number, just to keep things clean and simple, the forward price to earnings ratio is 21.9. So if you were to pay $21.9 or $22 per share of earnings in the S&P 500, as you can see, the rate of return, if we just go over to the left, is not great. It's in the low single digits. Now, why is the news even worse when you start to think about the forward-looking versus the current? Well, as I talked about at the beginning of the video, the current price to earnings ratio of the S&P 500 is 27. And so if we look at this chart, and we said, look, we don't want to hear about the future expectations because no one knows what's going to happen in the future. Earnings could go up, earnings could go down. What is it today? Today's price to earning ratio is around 27. And right now we're at the beginning of March. Okay. At 27, when we look at this chart, where does this put us? Well, this puts us literally off the charts, expensive, based on the numbers in this version or this period of history, which means if this chart continued to go down, the future expected rate of return at 27 times earnings over the next 5 years does not look good. Okay? Now, is this to say it's impossible for the market to go up over the next 5 years? Absolutely not. And over the next 12 months, who knows? But what it does mean, and when we're talking about current and forward price earnings ratio, a lot of these charts and a lot of these assumptions are just that. They are assumptions. And it's important to take a look at the price you are paying today, not a future story, not a potential future estimation of earnings, but what is it today and what do the numbers tell us the future looks like from there? I hope you found this helpful. And as always, thanks for investing your time with the Personal CFO.